Quick introduction. My name is Brendan Gleeson. I'm one of the senior advisors with the GP Wealth team. You probably know one of more of myself, Stephen Thomas, Andrew Warren, Barton Lynch, Ben Osborne, and Carmela Kyle. We're also Simon Forbes and some of his clients are here, as well as I think Dane Parsons and Laurie Ellis. These guys have been great with us in terms of building a bit of a network internally that follows a lot of the work that Barwon and Eleanor do. We've piggybacked off a large part of the work that they've done over a number of years, so it's been quite good for us. But as I noted, tonight's all about property, and I think that we're trying to bring people a bit closer to the space. I know our clients we've only been introducing a bit of this over the last year. There's been a number of questions that kind of tick a lot of boxes for this space. So people are looking for lower volatility, reliable income, more defensive assets. I think there's a certain level of comfort when you're dealing with property because people understand the space in kind of one or more ways. So there's definitely great ingredients for a diversified portfolio for us. And whether you be clients that are looking for better risk-adjusted returns or retirees looking for a better income, both of these spaces, be it with Eleanor, who's more on the investing and equity side, and Barwon, that's more on the credit side, both of these areas play a great part in the portfolio, and they've been quite rewarding for us. Great relationship. We get a chance to speak to these guys all the time. So we always find that we're kind of enjoying learning and finding new ideas that we then pass on to clients, but good opportunity for you guys to be on the front of that as well. So today, each speaker's probably going to go for about 20, 25 minutes. We'll have time for questions at the end. We are recording, so if we can hold off for questions at the end, just so we're a bit slicker on that. It will be available on our website, online for those people that maybe want to go back and go over it again. But in terms of the first speaker, Eleanor, who will be speaking first, I might ask Marino to introduce the team and Matt, and then you can take it from there.
Thanks, Brendan. Good evening, everyone, and thank you for the opportunity to speak to you today. And Lisa for putting this event on, so thank you. And with me from Eleanor, I've got Matt Healy, who's Head of Retail Mixed Use and Development, and Am Neat, who's Co-Head of Industrial and Logistics. So the Eleanor business, I don't know how much everyone knows about Eleanor, but it is an ASX-listed real estate funds management business. If you're following the stock, you would have known that a significant transaction completed about 3 weeks ago. Eleanor acquired Challenger's real estate funds management business, a total of $3.4 billion of real estate in that portfolio. That takes the Eleanor business from $3 billion to $6.4 billion of funds under management. The $3.4 billion of funds under management comprises of 2 equity mandates, one from the Challenger Life balance sheet, and the other is a $700 million mandate to the 5th largest sovereign wealth fund in the world, Abu Dhabi Investment Council. Now, that transaction took close to 9 months to be completed. The level of due diligence, regulatory approval to facilitate a material outsourcing arrangement for a life company and a sovereign wealth fund was a no mean feat. But what it does do is really provide a rubber stamp for the Eleanor business on its credibility that has really been built on the track record that the team has delivered. So I might hand over to Matt Healy, who, as I mentioned, heads up our retail and mixed use and development, to talk to you about the opportunities in that sector.
Great, thanks, Marino. Guys, it's a pleasure and a privilege to present. Thanks, Brendan, for the opportunity. Eleanor is a business. We're here today, and myself and the very capable Barwon team, to talk about why you should invest in property. It's an opportune time because if anyone picks up the AFR, the Australian, or wherever you get your news, there's no doubt that you will find various economic commentators, forecasters, talking about the doom and gloom of office, talking about the sector that's going to be confronting the greatest headwinds, pretending to know which sector you should be backing that's going to have tailwinds. Retail, development and mixed use is a sector that, as Marino identified, makes up close to half of our $6.4 billion of funds under management. We believe we've got a key point of difference in that sector, which has allowed us to grow the platform and the portfolio and to win the trust of companies like Challenger and the Abu Dhabi Investment Council to act as their custodians of capital and manage their real estate moving forward. So what I wanted to do today was really bigger picture, talk about why invest in retail. I've been in the wilderness, guys, for 8 years. There's a thing called Amazon that came in 2015. And over the years, I'm a civil engineer by trade, but I cut my teeth with Westfield for nearly 9 years as a developer, and then spent 4 years with Lendlease, and more recently 3.5 years looking after Blackstone's shopping centre portfolio in Australia. Retail was a dirty word, and that was because of the online penetration, the vulnerabilities of retail, or the perceived vulnerabilities of retail, with omni-channel and e-commerce. People clicking, consuming online, and no longer having a need, desire, or requirement to visit shopping centres or retail. Well, that was fundamentally wrong. And over the last 2 or 3 years, that thesis has turned out to be grossly incorrect. Elanor as a business has tried to, through a counter-cyclical and a contrarian lens, hoover up and acquire as many shopping centres as we could, where we believed there was a dislocation in pricing. Now, why did we do that? We always thought there was going to be an underlying fundamental thesis that would play out in that this great country of ours, in which we're the luckiest in the world, is always going to have high net migration. We've now got 458,000 people coming to our shores. That is growing population growth, and the need for retail and sales momentum has lifted over the last 3 years, even throughout COVID. Secondly, and on this slide, the proportion of online sales has actually drastically reduced from 15.5% to 10.4%, rather than 10.4% in March. It's back up to 10.8% as of June, the latest measure. Australians are very conservative by nature relative to other Western democracies. We like to actually touch, feel, be a part of the retail therapy and theatre that shopping centres create. And it's an ecosystem that we've been trying to leverage by buying underloved, some would say distressed property, shopping centres and retail assets that typically are located in the best real estate, adjacent to transport nodes, adjacent to freeways, critical infrastructure, incredible amounts of built form, on-grade car parking, with the ability of introducing mixed use and alternate usages to what is fundamentally superior real estate. The population growth that has played out over the last 12 months is also coupled with now extraordinary inflationary pressures. Everyone's picking up the mass media and understanding we've got builders falling over, left, right and centre. Construction prices have gone up 42% over the last 3.5 years. What that is going to do, it's going to ensure there's going to be a lack of supply, new shopping centres, new neighbourhood, sub-regional and super-regional shopping centres being built. Population growth, lack of supply, retail sales, consumer sentiment going up, all leads to one thing, and that's rental growth. And when rental growth occurs, naturally, you'd like to think the underlying value of those assets are going to improve as well. For the first time in 9 years, we're starting to see improved and positive leasing spreads. When a retailer, a medical centre, has a 5-year lease, they were paying $100,000 in income. Over the last 6 years, when we go to renegotiate that lease, even though it's an essential need, that doctor or suite of doctors would say, we're only going to pay 80 grand. Well, now they're going to pay 110 grand. We're going to increase the rent by 10%. And we'll do that because of lack of supply, population growth, and Elanor is a successful manager that's got a track record of ensuring that that shopping centre has great footfall, it has a relevant tenancy mix, and you as a retailer are going to be treated like a partner, like a customer. We talked about the retailer spending resilience. Why retail? It's amazing, guys. It acts as an inflationary hedge. 38% of the income that's generated from my portfolio is from Coles, Woolworths and Aldi. Now, ultimately, during high periods of inflation, you tend to have, all of the leases within our centres are CPI plus 1%, CPI up to 4%. So retail as an asset class acts as a natural hedge to inflation, which is another reason why we're starting to now see offshore capital coming to Australia and actually looking at retail as an investment asset class relative to industrial and logistics, which I don't want to dispel Amneet's opportunity with us at Elanor, but it's been an asset class that's been in the sun for the last 5 or 6 years. What does all that mean? That's meaning valuations for shopping centres and retail and mixed-use assets are not only holding up, we're starting to get some tightening. We're starting to get some value uplift. Now, why is that? The underlying cash flows are sustainable. The perceived risk of online penetration is not as bad as everyone thought it was going to be. But then more importantly, come in Spinner, anyone who knows how to develop property and understands the fundamentals of the built form realises that shopping centres provide the superior real estate to introduce residential, build to sell or build to rent, commercial, office, medical, health, wellbeing, all these additional asset classes that can be incorporated into what is already a living and thriving shopping centre environment in which people want to live, work and play, all within, as we're typically hearing, a 15-minute economy in which a lot of the local councils are striving for at the moment. What does Elanor have relative to our peers? We do believe we've got a differentiated capability. We're a private who thinks like a private in an institutional world. The reason why we were able to take Challenger's real estate platform is because we've delivered a 25% IRRs for our investors over the last 9 years. Now, how do you do that? You've got to buy well. You've got to know where to buy. You undertake your top-down analysis as well as your bottom-up. You look at the sustainability of the cash flows. You see what you can do to add value to that asset. And you only do that by having a team of executives across the various different functions. So we always originate well. We always have a strategy in mind as to what we're going to do with that asset. That sometimes means you pivot. That sometimes means assets you were going to incorporate a commercial office tower 5 years ago, 4 years ago, you're now incorporating residential, build to sell and build to rent. So we believe we've got a differentiated capability in buying in the areas where there's going to be long-term positive, fundamental, positive growth with demographics and population growth. But more importantly, we always have a strategy as to how we're going to execute and unlock value in that real estate. You do that through every single point of the asset life cycle. There's no point in just buying the worst house on the best street and leaving that awful kitchen in there for the next 15 years. You've got to actually improve that asset. Now, how do you do that? You kick out Myer, you kick out Big W. You repurpose and remix those centres to embody a tenancy mix that's befitting with not only the customer that's visiting that shopping centre now, the customer that's moving to that area. And increasingly Australia, with that population growth, you're seeing gentrification in all those areas. You're seeing it in the regions. We've been one of the biggest investors in within an hour and a half out of your major CBDs. We've bought in Toowoomba, in Wollongong, in Riverside, down at Queanbeyan. And COVID really expedited that process of people realising you didn't need to live in the major capital cities. Every point of the life cycle is how we extract value for investors. And you can't just originate and have a strategy in mind. You need to be constantly reevaluating that strategy and working that asset as hard as you possibly can to drive investor returns. Unashamedly, we will talk ourselves up. We've delivered 25% IRRs over 9 years for our realised investments. And we've done that by leaning in, working hard, having an in-house integrated platform across asset origination, asset management, leasing and development. And you can only do that when you control everything in-house and outsource anything that doesn't move the valuation needle, such as property management, finance, and also some other secondary functions that we don't control in-house. Off the back of the Challenger acquisition, we're finally getting some scale. And scale is important in property. It allows me to have a better phone call with the head of property from Woolworths about where I want to put him in the next centre that we're going to acquire. So we've now got 22 shopping centres and we've got geographical spread with an asset over in Auckland in New Zealand as well. There's no point in me talking about the cows come home. A case study can more often than not really tell 1,000 words and indicate how you take unloved assets and reinvigorate them. We bought a shopping centre in Auburn. A lot of people turned their nose up about Auburn, thinking, why would you want to buy that asset? We bought it at a little over an 8% yield. It was unloved, it was distressed. The owner didn't really know what to do with it. It had a Woolworths supermarket and it had a Big W. The Big W was disgraceful. They were turning over $1 million and paying $900,000 in rent. We bought the asset beginning of 16. I tapped Big W on the shoulder. They had a 10-year lease in place. Some people thought I had rocks in my head for telling them, would you consider entering into a deed of surrender? They paid me 3 years rent to leave because it wasn't performing that well for them either. And I used a quarter of that capital to reposition that Big W space into a brand new Audi, a brand new Tongley Asian supermarket, an appropriately sized medical centre, and an appropriately sized fresh food precinct. Now, that same $900,000 of income that was being generated out of Big W now generates $3.5 million of income. But more importantly, the rest of the shopping centre got a lift, what I call the halo effect. People do a cross shop between Woolies and Audi. So it improved the overall fundamentals and the dynamics of the rest of the shopping centre. Subsequently, we divested of that asset to SCA, which has recently been rebadged as Region Group for $129.5 million, giving investors along the way a 24.5%. Now, it happened through buying well, originating an asset that a lot of people weren't prepared to compete on, but then always having a strategy in mind and executing on that strategy ruthlessly, which I will say, a lot of our peers and competitors, they covet having funds under management. They don't necessarily roll the sleeves up, get in and do the hard work that's required on a day-to-day basis. We've done the same in an asset in Queanbeyan, an asset that had a vacant discount department store when we bought it. We bought it at an 8% yield. We believed in the fundamentals of Queanbeyan. Again, top down. There's no point in buying great real estate if it's in the wrong location. So this was an asset, town centre. Queanbeyan is effectively the secondary CBD of the nation's capital. It's only 9 kilometres from the airport. We bought the asset for 8%. I knew that there was going to be leasing demand. We did a deal within 8 months with the Australian Electoral Commission, backed by the Australian government, a 5-year lease. Subsequently got the asset revalued from 60 million to 115 million, went to the bank and refinanced, gave the investors 62 cents back of the dollar that they gave us within the first year and a half. And they continue to now get a 13% distribution from what is a dominant neighbourhood convenience core asset. But it didn't look like that 3 years ago. We've turned it into that. And we've turned it from 78% occupation to 98% over 2.5 years. We're doing the same at a number of our assets. We've got a $250 million development pipeline. We bought another unloved asset in Wollongong called Warrawong Plaza. First thing we did is we tapped Target on the shoulder. Target, we're doing 11 million in sales. We knew Coles was doing 65 million in sales. Coles and Woolies love to compete. We did a deal with Woolies pretty quickly for them to take the old Target space. And off the back of that, Woolworths are now going to introduce, sorry, those guys that are online, I'm pointing to something. Woolworths are now going to introduce a brand new online fulfillment centre that's going to be vertically stacked, which is 9 stories in the air. And that will satisfy the ongoing online fulfillment requirements for the Wollongong area, in which they'll run 9 Pantech trucks out of the back of that particular Woolworths supermarket store. Again, same thematic, bought it for 136. Within 2 years, 2.5 years, it's worth 160. Once Woolworths are up and trading, beginning of 2024, a valuer has given us an ASAC complete valuation of $210 million. Now, that all sounds great, but the benefit for investors, they've been getting 6 to 7% distributions along the way. So not only do you get consistent, reliable distributions along the way, because the manager knows how to manage the real estate, you'll then get a value pop at the end, because it'll be worth $210 million once we get Woolworths up and trading. Shopping centres don't always have to just be shopping centres. I talked about the opportunity to introduce extraordinary mixed use and other alternate usages to what is superior real estate. We bought a 5-hectare site on the border of Coolangatta and Tweed a year and a half ago for $87 million, an unloved asset. The vicinity at the time wanted to move on from their books and was non-core to them. Over the last 9 months, we've worked up a strategic master plan for 1,500 apartments to be developed on top of what will be a core shopping centre. It's already got a Coles, a Woolies and an Aldi. Leveraging our relationships, I've got Coles, Woolies and Aldi agreement for leases for me to relocate them to non-premium parts of the site, rebuild brand new basement car parks, 20,000 square metres of core retail, which is the supermarkets, but then we can leverage off the Gold Coast International Airport being 3 minutes up the road and Coolangatta around the corner to develop up to 1,500 apartments in what's an amazing lifestyle destination. Now, investors that came into that fund late last year, we told them we'd get you a 25% IRR over 3 years and you'll get a safe, consistent 5% distribution along the way. They've got their 5% over the last year and a half. I am now of a yield with the state government, and the state government supporting up to 1,800 apartments. So the intention will be over the next 2 years to start marketing this asset. It's arguably one of the best development sites on the East Coast. We would then divest of that asset and give investors a better than 25% IRR for not taking too much risk along the way. We've got 2 or 3 other opportunities that we're working on at the moment. We're delivering a brand new fresh food market in the nation's capital, Belconnen. Why did we do that? Canberra's got the highest disposable income in the land. And they like their fresh food, they like their produce, they like their food and wine. They don't have a fusion of fresh food and casual dining in the one spot. So we're developing that in Belconnen, and that project's scheduled to open in November of this year. A bit about the team. We've got 24 executives within retail and mixed use. Eleanor's got circa 105 executives now. We've grown incredibly. When I joined 4 years ago, we had 1.8 billion of funds under management. We've grown that to 6.4. And Marino probably didn't make the point before, he ran out of time. We take in the investors that invest in our product are paramount. We're ASX listed. Eleanor is an ASX listed business. But our CEO, Glenn Willis, often makes the point, investors in Eleanor's headstock come secondary. Investors in our individual unlisted funds are always our priority. And that's how we've been able to generate those higher returns, because we always make decisions that are in the best interest of the investors that invest in our funds. I'm going to hand over to our newly minted Head of Industrial and Logistics, MD.
Thank you, Matt. And thank you, everyone, for giving us the time to come and chat to you guys today. So, as Matt rightly pointed out, I've recently joined Eleanor. I think I'm about 7 weeks in now. And my role within the team is I'm heading up or co-heading the industrial and logistics space. And there's another co-head, Myron. He sends his apologies today that he couldn't make this event. He's on a plane back down to Melbourne. So Myron is also co-head of industrial. We both work together at Logos. So prior to joining Eleanor, I was at Logos Group, which is a industrial developer throughout the Asia Pac region. And all we did was purely industrial and logistics property within Australia, but also throughout Asia Pac. And my specific role within the organisation was I was a fund manager on the largest developed core vehicle that we had within the organisation. So for those of you who aren't familiar, as fund manager, my principal role was driving the strategy, making sure that the fund was growing, we were buying the right assets, making sure our development pipeline was per what we had communicated to the investors, and then also liaising with the investors. And the investor that sat in that fund was a large sovereign wealth fund in Abu Dhabi Investment Authority. And so during my sort of tenure as fund manager, we started off at 1.2 billion. I grew that fund to about $5 billion in the 4.5 years that I'd spent at Logos. Just a quick sort of snapshot on Myron. He was at Logos at the same time I was, so he spent about 4.5 years there. His role was, he was the general manager of the Victorian, South Australian and WA development business. So his principal role was obviously originating investment opportunities, but then also managing the developments and liaising with our tenants and making sure that we were developing product. So a bit about our track record. Look, together we did about 1.6 billion in land acquisitions. We had about 860,000 square metres of leasing deals completed. And we had about circa 6 billion of development projects underway. That was sort of my fund and Myron working hand in hand with his team and the broader business to drive that value. So I guess that's all well and good. We've got our track record, but what does that mean and what are we bringing to Elanor? And the way I like to describe it to people is that we're bringing a complete end-to-end platform to Elanor. So that ranges from acquisitions, development management, leasing, funds, and asset management. So from a acquisitions perspective, we've isolated a clear thematic that we want to pitch to capital. And that is we're focusing on pure last mile and middle mile logistics. That's our point of difference and that differentiated capability that Matt was alluding to earlier as Elanor as a brand. So what does that mean? Everyone, that's a buzzword, last mile logistics. So what that means is, being close to population from a distribution perspective. You've got massive trends in e-commerce and all these occupiers, they need to be close to their end destination. So where they're distributing to people's homes. In their supply chain, transport is the biggest cost of a 3PL or a logistics provider's cost base. It's not their rent. Their rent makes up roughly 5% of their cost base. It is transport that is their biggest cost. The closer they can get to their end destination, the more profit these guys are making, right? So I'm talking about the groups like Aussie Post, DHL, Tolls of the world. So, being focused on last mile logistics, that is a sector that, a lot of the guys who are operating in the industrial and logistics sector, they are at the bigger end of town. They're focusing on buying your large 24, 10, 20, 30 hectares of land and doing industrial development. So who I'm talking about, Goodman Group, Dexus, Charter Hall, GPT, all those guys are focused on the higher end of town. Our strategy for last mile logistics is we want to focus on land parcels size between 2 and 5 hectares. And the reason we're doing that is we want to bring an institutional expertise and what we've done at Logos and our previous lives to that sector of the market because it's underserviced. The big guys, the big end of town, they don't want to, I'll use the word, waste their time doing smaller ticket sizes because they're investors, they're institutional investors. They like to write equity checks of, 100, 200, 300 mil plus. They don't like to spend the time and effort from a business perspective to write a $30, $40 million equity check. And, if you're a DHL, a Toll, an Amazon, and those guys who need logistics requirements, the types of people that you're dealing with are your unsophisticated investors. So they're not getting an institutional service and an expertise in that area. And that's what we want to exploit by bringing that capability. We're also focusing a little bit on middle mile logistics. So what that means is it's not last mile, i.e. close to population and key motorway networks. It's that next rung out. And the reasons why we're focused on middle mile logistics is, once again, if you're operating in the right size in the market, you aren't competing with big institutional groups, and you can add a lot of value and return upside by operating in a space and bringing that skill and expertise.
It's a little bit hard to hear you, if that's all right.
Oh, sorry. Is that better?
Yes.
Yeah, sorry.
Thank you.
From a development management perspective, look, we bring a strong track record in terms of our relationships that we have with our builders that we've done a lot of work with throughout our previous lives. So we can leverage those existing relationships to drive value for investors. And from a leasing perspective, we've got very deep networks with tenants such as Woolworths, Amazon, DHL, Coles, Toll, all those groups. We are well known to those groups, and we are aiming to exploit our relationships with those guys to then bring them to our last mile logistics once we acquire the land and back solve their logistics requirements. And we're in active conversations with groups such as Amazon to work on a last mile logistics strategy for them. So that's the expertise that Myron and I bring to the Elanor platform. Now, I think the $1 million question here is, why industrial, right? So what are the themes that are driving the industrial sector? And Matt, you sort of touched on some of these, but at the moment we've got historical low vacancy rates within the industrial sector in Australia. So nationally, the vacancy rate in industrial is 0.6%. It's the lowest it's ever been. If you are an occupier and you need space in industrial and logistics, good luck finding it right now. And that is basically driving a lot of rental growth. So last year we saw about 35% rental growth in the industrial sector. In the year to date this year, we've probably seen another 10 to 15% industrial rental growth. And if you look at overseas markets, who are a good proxy for what's going to happen in our local market in Australia, in America, for example, they've seen rental growth of upwards of 70, 80, 90%. And that wave is coming for us here. And the reason for that is you've got land supply constraint issues. So if you have a look at Sydney, where are you going to find 5 hectares or 10 hectares of land to do industrial development? You have to go all the way out to Kemps Creek. And developers have bought in Kemps Creek, but they can't develop the land because the government hasn't delivered the infrastructure. So there's a massive shortage. You've got a lot of demand. You don't have the supply to keep up with the demand. What's that doing? Driving up the rents. So if you can find the right size assets in key core infill locations, you can exploit that with the customer base that need these facilities.
Needs, are you accepting questions at this stage or not? Or is that the end?
I can, but I think
We
we'll...
might wait till then if that's all right.
Sure.
So long-term population growth. The rule of thumb that we generally work to in industrial is for every single person that comes into this country or is born in terms of population growth, that equates to roughly 3 to 5 square metres of additional industrial floor space demand. So what does that mean? Australia's population growth is forecast to increase by about, let's just call it 1.1 mil. That's going to generate an additional 3 to 5 million square metres of additional demand. Now, that is on top of just general growth from logistics providers that need additional space. This is an additional 3 to 5 million square metres. That then feeds into the thematic I just talked on earlier. We don't have the land supply to keep up with the demand. That is going to keep putting pressure on rents because of the demand supply imbalance. Matt touched on e-commerce. I will admit, yes, the penetration rate has recently come off. However, if you look to overseas markets and other developed nations such as London and the States and Canada to some extent, Australia is on track to hit those penetration levels. We're probably hovering in the early teens. I think you're at 10%. We're forecast for that to increase to circa 20%. What does that mean? That drives an additional 3 to 4 million square metres of additional demand. Now, that 3 to 4 million is on top of the 3 to 5 from the population growth. There is a lot of strong tailwinds within the industrial sector that is driving demand for logistics space from these occupiers. I want to touch on cap rates, the $1 million question. So yes, like all property cycles, we are going through a repricing at the moment where cap rates are starting to soften. They're coming off their peaks. I think in Australia, we've got down to about 3.5 to 3.75% from a peak industrial cap rate. We've seen that soften through to about 4.25 at the moment is where the prime industrial cap rate is at the moment. What we're probably expecting is another 25 to 50 basis points of cap rate softening to come through towards the back end of this year. Now, what does that mean from a develop to core strategy? So whilst cap rates are softening, we've had construction costs go through the roof. As Matt pointed out, we've probably seen 40 to 50% construction cost increase. Rents have obviously kicked up a fair bit, and that has saved, I guess, the sector from a profitability perspective. The one thing that we haven't witnessed and that is yet to play out is the last variable left to give in a cycle is land. Land cost hasn't softened just yet. If cap rates continue to soften, land is expected to come off. And the reason I say that is developers, if they're not making margin, developers turn the tap off. Land vendors will automatically adjust their pricing expectations to ensure that they can still trade on their land. And that will then allow developers to come back into the market to continue developing. So from a cap rate perspective, yes, we're seeing pressure, but we are going to see some drivers of growth that will continue to offset the cap rate softening cycle. The last thing I just wanted to touch on is technology. So technology is a massive driver in logistics at the moment from a robotics perspective, but just modern industrial logistics facilities. And if you have a look at what Amazon have just done, they've done about 300,000 square metres out at Eastern Creek. That warehouse is predominantly operated by robots. So robots run on the factory floor, they pick product, they send it out, it gets packaged up, it's out onto a van straight out to the customer. We are increasingly seeing a lot of groups, your DHLs, your toll groups, all those 3PL logistics providers coming to us asking for new facilities that are capable of handling their automation requirements. You have to remember, for a facility to be automated, a lot of the old existing facilities can't support the automation infrastructure. So you do need to get a brand new facility. Once again, I come back to what I touched on earlier, land supply, you're constrained. That's going to continue driving demand, and that's going to keep putting pressure on rents. Skip over that. And I just wanted to touch on a couple of examples that we're currently looking at in terms of industrial and logistics opportunities. So this particular facility here, for those that don't know, it's in Oakley down in Vic, which is in the southeast of Victoria. So very close core infill location from a last mile logistics perspective, close to the population centroid of Melbourne from a logistics perspective. There's a current facility in the bottom left, as you can see, shaded in red. There is a current facility. The particular owner of that facility is currently building the brand new facility down the road, and they're investing about $100 million into that facility. The reason for that is, as I touched on previously, automation. So there's currently an opportunity for us to come in to acquire their existing facility, the one that they're moving out of, and essentially to do a bit of a value add play. And what I mean by that is, if you just look over to the right where we've got Unit 2 and Unit 3, that is the existing warehouse that we are looking to retain. We are then going to demolish this section here and add on 2 additional units on the side, which is Unit 1 and Unit 4. And what that means from a valuation perspective is you're coming in, you're buying a facility that is only 22,000 or just less than 22,000 square metres. You're then bolting on an additional 8,000 square metres and you're driving that value upside. What you are also doing is by carving the facility up into 4 smaller units, you can then charge your occupiers a higher rent. So that the smaller the facility, the higher the rent. So that would be a valuation play. You're talking an end value of about 80 mil. Your purchase price here is probably in and around the early 40 mils. So that's the sort of value add play that we're looking at. Once again, core infill location, as you can see from this image here, the estate is surrounded by residential. Another example, once again, down in Victoria, this time up in the north, in a suburb called Broadmeadows. The reason why we like North Melbourne is there's a couple of reasons. One, from a logistics perspective, Melbourne's population is spread in all geographies. You've got population in the west, the north, and the south and the southeast. So being in the north, it allows you to quickly get to each side of Melbourne to deliver your product from a logistics perspective, being up in the north. The other reason the north is becoming very popular with big institutional groups is from a line haul perspective. If you're a logistics group who is sending product from Sydney down to Melbourne, you can do Sydney to North Melbourne, Broadmeadows in one truck shift, 8 hours. So your truck drivers don't need to stop, rest, stay overnight, and then continue that journey. So from a logistics perspective, it is very high in terms of its connectivity and cost savings for occupiers. The strategy here is to buy an existing nursery at the moment. That tenant no longer needs their space. So we would come in, buy the nursery, basically demolish all the improvements on site, and then we would develop one big box industrial facility split into 2 smaller units, circa 5,000 square metres each. Once again, that's driving the value upside. We're talking sort of 33 mil on completion. The purchase price on this particular facility is going to be about circa 10 to 11 mil. So they're the sorts of opportunities that we're trying to uncover. Once again, core infill locations that have value upside or core plus, type development opportunities.
Like to carry on there, that's all right.
Yes.
Just to go on that, appreciate that. Very comprehensive. We'll have time for questions at the end of this. Obviously, a bit to unpack there, and introducing our next speaker, Jonathan Pullen from Barwon. He's one of the partners there and also in charge of property finance. Barwon actually manages about 3 billion across a number of different property capacities in terms of alternative assets. So this is just one of the sleeves that they operate in, but actually one that we're pretty passionate about. I was actually speaking to Jonathan before about some of the conversations that we have around credit and lending. Typically a question for a lot of people that don't have much exposure to the space is that, well, why don't they just lend money from the banks? What's the difference there? And I think that there's a lot of education we spend, because a lot of the opportunities in the credit space are quite valuable, as you'll see with some of the risk reward kind of outcomes they're able to deliver. Reality is a lot of the space they're lending to, the banks can't lend to anymore with new kind of restrictions around capital and also growth in credit. There are a lot of areas there where the banks actually probably wish they could lend to, but just don't have the capacity to do it. In saying that, doesn't mean you want to lend to anything or anyone. You do want a professional manager like Jonathan behind the wheel and helping guide through that terrain. But again, when we're looking with a lot of questions with clients that are looking for reliable yield, kind of a lower volatility, this is a great ingredient for a portfolio, especially in the credit and fixed income space. So if you're all right to give a bit more of a background in terms of your kind of position and rundown, you're much better than I, so thank you.
John, I'd hope so. Thanks, everyone. Pleasure to be here. I'm to set my timer as well, so I'm going to kind of move through this reasonably swiftly so we can get to some Q&A at the end. So just quickly, as I touched on before, so Barwon, an independently owned manager. There's 5 partners of the firm, myself included, independently owned, $3 billion under management, formed in 2006, and we have 50 team members with head office here in Sydney, actually, just not far from here. And we have 3 areas to which we focus all of our investment activity. The first is we're a direct owner of healthcare real estate across the country. The second is the property finance division, which is the capacity I'll speak to you today on. And finally, our third investment division is a private equity strategy. In terms of the clients that we serve at Barwon, Barwon is a bit of a unique beast in that primarily we're actually an institutional fund manager. What I mean by that is about 65% of our capital that we manage is true institutional groups, and the balance really is what we would internally refer to as kind of mid-market investors, which is wealth management groups, sophisticated family offices, and that kind of thing. We don't cater to any form of retail investor whatsoever. The benefits of that being that really we bring to wealth management groups like Shaw and Partners at family offices and things like that, really, in my mind, kind of institutional grade management, rigor and process, and we bring that investment opportunity down into smaller investment size parcels that meet that mid-market space. The due diligence process that we run on all of our investments, our funds, how we run the business is very onerous, but that comes through many, many years of running institutional capital where the standard is exceptionally high. So in terms of property finance and particularly first mortgage lending, I just talk more generally about it before we dive into our primary fund. I put this slide up. It's very, very simple. I'm sure we're all across it, but I just like touching on capital structures whenever we dive into any of these presentations. So when we talk about first mortgage investing, we're obviously in the capital structure in the senior position or the first position in the capital structure. We also benefit from a mortgage security over the particular piece of real estate or whatever it may be that we're lending against. I'll use the word traditionally. Traditionally, a first mortgage debt position goes up to about a 65% loan to value ratio. So what I mean by that, if the property was worth $10 million, say, for example, the first mortgage position traditionally would go up to a $6.5 million of value, or a loan of $6.5 million against that $10 million worth of properties. Now, there's many different interpretations on where that limit should naturally sit. But what we would like to think is that when we bring an investor a first mortgage investment opportunity, the connotations they should have with that is capital preservation is really the first thing. It's very, very difficult to go out into the market, continuously be able to secure investments where you go up and over, say, a 60-65% loan to value ratio, and then continuously be able to stand in front of investors and say, listen, in most conditions here, I'm reasonably confident that our capital is protected. Once you go north of that number, you start stepping into a higher risk territory, which particularly in the market cycle, particularly where we are now, you do run the risk of potentially some form of capital loss in your investment. So then stepping through the balance of the capital structure, we've then obviously got second mortgage debt positions, preference equity positions, and then obviously ordinary equity positions. Not all capital structures look like this. They're all different, everything in between. But when we're talking here today, we're talking the senior debt position with first mortgage security, and is what we would say limited to a 65% loan to value ratio position. So why do we like the Australian credit market, property credit market? Why do we like it? Well, I would say in 2011, 2010, when I first entered into the space, the landscape was very different to what it is today. It has been evolving really since that time, and it's got a long way to go from kind of where I think it will stabilise. If you go back to 2010, the landscape really was major banks here in Australia would occupy somewhere in the vicinity of 85 to 90% of the available commercial real estate credit in the country. They were taking up 85 to 90%. What has happened over the last 10 years and continues to as we're moving forward is the dominance of those major Australian banks is reducing. That is for a variety of reasons, mostly obviously because of the involvement of APRA, the Basel III regulations that have come through. Effectively, it's becoming more and more difficult for banks to lend into the same situations as to what they used to 10 years ago. So their participation has had to reduce in the market because of regulatory pressures. The other thing that's happened with the banks are things like royal commissions, various scandals that have come out of that. You know, being a bank for a very long period of time hasn't really been in vogue. And particularly with property lending, we've found that their involvement in property lending has wound back as a result of a lot of that. you had things like COVID and just all this heightened volatility that's gone on. So what has then happened is a lot of non-bank lenders have stepped into that void in recent years. So why do we like this style of investing? So when we go and do a senior debt position secured over a piece of commercial real estate, the benefits for the investors on the other side of that is we're providing them stable and regular income derived returns. So no capital kind of growth returns, it's more income style returns. We've obviously got the benefit of the strong underlying security and obviously limited risk in terms of capital erosion kind of events. We've got the ability to build out a diversified portfolio of this type of investment, which I'll talk about shortly with the other managers that participate in the market. The one thing, I suppose it's a positive, it just depends on the term in terms of the types of funds that you enter into this type of investment, but it is a limited, I mean, all property has limited liquidity. That's why we get a big part of why we get the premium to the returns. But what you're able to do in a lot of these debt funds nowadays is often they're pooled funds. They benefit from many different positions, and those funds themselves can drive to create a lot of liquidity back to investors. So things like redemptions and getting your capital back more freely has increased, but I will caution that we can maybe talk about some of that in the Q&A towards the end of this, because there's a long history of some of these funds run by inexperienced managers really over-promising that liquidity. So that's a really important part for investors to be across. What are some of the negatives? Some of the negatives of senior debt investing or any form of debt investing is those beautiful IRRs that Eleanor had up on the screen, the 20s, 30s, 40s. We don't capture that upside, right? We don't capture that upside, but at the same time, I'll say that we don't capture the downside in the same way. We sit there with a stable return, 7, 8, 9, 10% IRRs. We trade off that upside to take that preference in the capital structure diagram that we showed you earlier. The other issue, and we just need to be really careful of this going forward, is it's largely an unregulated sector. It's emerged very quickly here in Australia. I mean, it did exist pre-GFC and it was largely cleaned out, but the growth in this sector just over the last 10 or 15 years, you have to approach it with caution. You have to do a lot of due diligence on your manager because it is largely unregulated. Effectively, all of this is done under the Corporations Act and it doesn't specifically speak to real estate credit lending. So there's a lot of reliance that investors need to place on the manager that is making the decisions for the creation of these funds and a lot of the lending activity that they're undertaking. So this is a slide I mentioned earlier. This slide, if I was to put this up 15, even just 10 years ago, there would, obviously excluding the banks, in terms of on the right side of them, there would be, I would say 1/3 of those names, if I was to put this slide up 10 years ago. The growth in the sector has been huge, emergence of all kinds of different groups presenting to investors like yourselves as specialists in non-bank lending. And they all tend to slot themselves into kind of different categories. Obviously, in terms of the dominant players in real estate lending space is obviously the major banks here in Australia. Then we've got institutional groups. Some of those names you'll recognise, particularly Gresham and Qualitas has become a very, very large business. Then we've got the opportunistic non-banks who tend to either swing in and out of the sector and provide their investors with more so kind of higher returning opportunities, and they might not be continuous players in the space. They might move in and out of the sector with cycles. The other, the last category on the far right there is what we call syndicators, peer-to-peer, or even brokers presenting as fund managers and offering these opportunities out to their investors, family, friends, that kind of thing. So there's this whole spectrum of different types of managers that investors can now get access to create a diversified portfolio of all different types of risks and returning first mortgage investments here in Australia. Just in terms of Barwon, where do we play or where do we like to see ourselves? It's somewhere halfway in the institutional grade world. Really what we're trying to do, as I touched on earlier, is secure these institutional grade styles of investments, but bring them to the mid-market investor base. So we kind of bounce around halfway in between those two worlds there. So within that whole world of real estate debt, as you can imagine, the commercial real estate market is huge. You can industrial, retail, residential, large, small, everything in between. What we've done over a decade now is really kind of refine our approach to where we play in the market. A lot of that in the early days has come from, just doing a large amount of transactions across the country. And as time has moved on, we've found things that effectively work better for our investors, than other types of investments. So where we've landed really on this is we tend to go to market and provide smaller, what we describe as smaller loans. So these are loans between $2 to $40 million in size. Why do we do that? It tends to be above the market where the kind of mum and dad groups, the old kind of the old lawyers, mortgage books kind of operate, but below the larger institutional groups who are providing the kind of $40, $50 million plus size in loans and investments to their investors. We're broadly sector agnostic and operate across Australia. There are two sectors to which we still cannot convince ourselves to go into, and that's even in the kind of conservative approach of a senior debt investment. That's aged care and rural. Happy to talk about that at the Q&A at the end. And the one thing that we've really carved out a bit of a spot for ourselves is what we've done is obviously we're lending and securing ourselves against commercial real estate. But what we've found over the years is there's another layer of credit that you can extract there, which is really in profiling, really understanding your borrowers and having a deep understanding of why that borrower is taking that loan from you, what they're using the capital for, what is their experience in whatever is the venture that they're undertaking, using those proceeds for. And if you really get into that, what you can tap into is a layer of credit enhancement where you can lend to these borrowers who quite often are high performing. Often they've never taken a loan from a non-bank lender. All their loans previously have been from major banks. They're heavily equity funded themselves, and they really stand behind the commitments they have with you and the facilities they take from you. So that's a part that we really focus on as a business. It's very easy to focus and analyze on the real estate. And what we find is a lot of the market overlook analysing the borrower themselves. So I'll just touch on our flagship vehicle, which is the Barwon First Mortgage Fund. Just checking on time, 6:36. So the Barwon First Mortgage Fund. So this is a vehicle we put together a number of years ago. This vehicle really, what we identified was that there are a lot of these first mortgage pooled fund vehicles around. None of them have been really set up with that kind of institutional approach. So what we find with a lot of these first mortgage funds that have been set up in the past, some of those, the names were on that previous slide with all those other groups who are operating in the space, they don't provide a lot of transparency. There's not a lot of clarity in terms of the underlying loans that they have on their portfolio. Are they construction loans? Are they residual stock loans? Are they all senior debt loans, or are some of them mezzanine debt loans? All of those kinds of things. And we found a lot of them really over promise in terms of their liquidity mechanisms in their fund. So what we put together was this Barwon First Mortgage Fund, and it's really a fund that we would otherwise set up for our institutional investor base, and we've kind of brought this to the mid-market level. So the fund itself goes out into the market on the borrower side of things, lends out into the market, limits itself to exposures that are no more than that 65% loan to value ratio that I mentioned to you earlier. Reasonably short duration loans, 6 to 24 months. So that drives the liquidity profile back up into the underlying fund. All the property is located here in Australia. The current target return of the fund, net of fees and costs, is providing back to investors between an 8.5% to 9.5% IRR. That has been moving quite rapidly recently because obviously the RBA keeps ratcheting up the cash rate. And a lot of our facilities that we have set have floating rate mechanisms. So the benefit of any increase to the cash rate is obviously flowing through to the performance of the fund and increasing returns. So the fund itself at the moment, and we talked about diversification before, the fund at the moment, I think it has 27, as at the end of the day, 28 underlying first mortgage loans, all located across Australia. average loan to value ratio of 60%. So in theory, what that measure is really telling you is we could come into the whole of portfolio, every position that we have security over, and decrease the value of all of that property that we have first mortgage security by 40%, and we'd still be sitting there in a capital with return of our capital and our that's a very simplistic way of looking at it, by the way, but a return of our capital and interest on all of those loans. The average duration of the loans is 12 months, and we have this focus on existing commercial property. So a lot of non-bank lenders provide a lot of capital to, and you'll read it in the news and you hear about it, to developers who are building large towers out in Western Sydney and all those kinds of things. And a lot of those developments and those developers go to these non-bank lenders because their project won't meet the bank's quality. So they will either not have the required pre-sales, they'll be using an inferior builder, they won't want to put enough cash equity into the project. So a lot of these groups, all these non-bank lending groups have filled their boots really with this, what we would internally call construction loan exposure to medium to low quality developers. We're very actively kept away from that style of exposure. What we've focused on is filling our portfolio with property that ideally isn't going through a construction stage. So a lot of this secured property that we have in the portfolio, the bricks and mortar will already exist on site. And I'll take you through that in some examples shortly. This I just touched on earlier in terms of the quality of the borrower. So this is really, really important. It's very hard to get down on paper. A lot of this kind of comes through just a huge amount of this style of business, but this is the layer of credit enhancement I touched on before. You know, providing capital to reputable, financially aligned groups, the kinds of groups that I could wheel into this room, we'd spend 5 minutes with them and say, I understand that person, I understand their business, I understand what they're doing, not I don't want to deal with them, they make me feel uncomfortable, get away from me kind of thing, which is it's very common when you deal with developers. There's a lot of different people in the space. So there's a lot of work that we do in this part, and we find that this is a really, really strong part of our portfolio that we do struggle to get across to investors, to be honest, but what we tend to find comes that bit is picked up by investors who deal with us over a long period of time. They see that performance of these borrowers over a long period of time, and then they go, I know what you mean there by the quality of the borrowers and what you target there. So in terms of some examples, these are some examples in the portfolio, but they're very representative of our wider exposures. So I used the term previously, residual stock loan. We do a lot of these loans. We really, really like these loans. So those pictures there, they're not renders. They are true existing buildings. This is a building up in Fortitude Valley in Brisbane. This is a developer that completed that building. It's a mix of residential apartments in that building. We then had a fund manager come to us and say, this developer is distressed. They've completed the project, but they're distressed, and they're looking to sell a large line of their completed apartments in the building, and we'd like to go in and buy them. And we said, we like the sound of that. What price are you buying them for? We'll go and reconcile that with a valuation. We will then come in and provide you 65% of the value of that valuation that you've got as a senior debt facility. We'll take first mortgage over all of those completed apartments. We agreed terms with what we view as our borrower, but is the purchaser of those apartments. We then sit with that settled. We sit there then whilst that the purchaser of those apartments has then leased up all of those apartments and is then in a process of progressively selling those apartments down as leased apartments to the market. So the fund manager who bought those apartments is making their return by way of buying the stock at an attractive price because they bought it wholesale, leasing it up and selling it to market as a premium. We're sitting there saying, okay, we're not getting the same lofty IRRs as you're getting on your equity side of things. In this one, we're getting about an 8.5% IRR, but we're sitting there in the first mortgage position up to a 65% LVR. So it's, you know, really with something like that, the scenario to which we come under pressure is we need the Brisbane apartment market to reduce in value by 35% in pretty short order for us to start to go, okay, we've got a problem here with our capital and return in this investment. So that's a recent example. This is another one in Canberra. In Canberra, you have obviously Parliament House, you have Old Parliament House, and then there's two buildings to either side, East Block and West Block. West Block is a building that we backed a fund manager into to buy. Fund manager, be no different to an Eleanor style group, go in and say, we like the idea of buying this building, conducting a refurbishment program, leasing it up, and then on selling it. And we said, we like the sound of that as well, but we don't want to go into that equity style risk exposure. We'll take the senior debt on that venture. So we've provided a first mortgage loan of just under $24 million, secured over that property. The developer then is undertaking a refurbishment there of that property, and which is now complete, and it's actually successfully leased it up to a government tenant. So again, through that whole journey, we kind of sit there and say, we actually ran the analysis on that as the developer comes in and buys the site, they complete the refurbishment program, but they don't lease it up. So we went and got a valuation to say, okay, the refurbishment program's done, but what if it's vacant? What is the value of this property if it's vacant? We lent off that value. So we've done that loan. We sit there on a 55% loan to value ratio on that. That generates back to our investors just under a 9% IRR, or just to the fund, just under a 9% IRR. And the final example, one a bit closer to home. So this is one in Mossman. So this is an existing, obviously older style apartment building in Mossman. They're the views from the back four apartments across the harbour. This was a loan, again, to a funds management group who has deep experience in buying these older style apartment buildings, doing a refurbishment program, and then effectively on selling them to the market. We've come in and we've said, we like the look of that. We'll participate with you on that. We're not going into the equity. We'll do the senior debt. We'll limit ourselves to a 65% loan to value ratio. But by the way, when we come in and provide that loan, we're going to measure the valuation on the property as it is right now. So our loan is limited to 65% of the value of the property as it is in the current form. In the meantime, the developer is going through refurbishing the project, uplifting its value. So over time, our LVR on that, if you assume that the refurbishment works are accretive to the valuation of that property, our loan to value ratio reduces over time. We still sit there and get our net of fees and costs 9% IRR that we send through to the fund. So that's just another example of a senior debt exposure we have in the fund. Very quickly, breakdown of the portfolio. This chart here really, I won't go through each one, but really what we've got is the portfolio now in total is about 70% of our property that we have security over is property that has some meaningful form of improvement on it. And effectively the bricks and mortar are already there. So we're really proud of that, because with that, that stat in the current market, as you can imagine, there's all kinds of issues going on with the construction industry. It's not to say that we're not immune from that, but we certainly don't have the same issues in our portfolio as a lot of other non-bank lenders have at the moment, when they're sitting on these large construction loans with builders that are going under or maybe going under, and cost overruns and managing all that style of exposure. So we don't have those same issues right at the moment. The trade-off actually, so we'll just talk about the negatives of that. The trade-off of that for us is our fund is slightly lower in its return performance than some other non-bank lenders. So a lot of non-bank lenders will say, oh, what you can get in first mortgage investing now is 10s, 11s, 12s, 13% IRRs. We would argue all day long, it's a very different style of first mortgage debt exposure that we've created in this fund. And we will take that trade-off in our return for what we believe is a significantly reduced risk profile with the types of exposures that we've got. Portfolio diversified across Australia. We don't have enough in Perth, which is my old hometown, so we'll need to work on that. In terms of the current portfolio, I won't take you through all of these, but effectively, as I said before, there's about 27 positions. We just had one loan today, so 28 positions in the portfolio. I'm just going to touch on this very, very quickly. Move to this next slide. So the target return, as I mentioned, we move that around quite frequently. In normal times, when the RBA isn't jumping around everywhere, that is quite stable. But currently, we've just upticked the target return to 8.5% to 9.5% net of fees and costs IRR. What we do in the fund, because we've got the diversified portfolio of underlying loans, we have the benefit of being able to make regular distributions. So we make monthly distributions through to investors. We have a reasonably rigid kind of entry into the fund. That's kind of hardest bit. The reason for that is we are trying to create for investors an exposure in its purest form for first mortgage loans. We do not want to be carrying large amounts of cash in the fund. That's not what you're there for. Like, there's many ways to manage cash, and it really shouldn't be up to us as the manager. So we try and keep the fund of a pure exposure of first mortgage loans with limited cash. So we tend to get a bit lumpy on the incoming process into the fund. But the redemption process we're really proud of. It's very, very simple. But what we do in the redemption process in the fund, when an investor would like to exit the fund, they can put that request in at any time. We effectively have 60 days to meet that redemption request, and we really then stand behind it. So we say if we can't meet that redemption request in the fund by 60 days, we won't undertake any new investment, right? So it's a really, really important part. I don't think there's any other fund like this where the manager's saying, I'm truly going to stand behind my commitments to investors. If they want to come out of the fund, there's no gating mechanisms or anything like that. But we can't undertake any new investment activity, which is a strong incentive for us to make sure we meet that redemption request. The fees in the fund average a 1.5% establishment fee for each underlying loan that we make, and then a 0.75 management fee on the way through. And I'll just wrap up with this. So obviously, first mortgage debt investing, as we touched on before, why do we really like it? Brings to the investors stable and regular income returns. Great security if you're entering into positions with sensible and well-measured loan-to-value ratios, build out a diversified portfolio, and in the right fund structure, you can get good liquidity through your portfolio. The fund itself that we've set up, the Bowen First Mortgage Fund, it is as pure as we can humanly make it. So it's true first mortgage exposures only. You read in a lot of the fine print for a lot of the other funds. They'll say 10, 15, 20% can be allocated to other. What's other? Quite often that capital structure diagram we had earlier, they're dabbling in bits higher up into the capital structure there to juice up the return of the fund. We don't do any of that. Average loan to value ratio of 60%. As I touched on before, we focus on these, for lack of a better term, kind of non-construction loans, and the current returns on the fund are that 8.5 to 9.5% per annum. And as I said before, we're really proud of the fund structure. It took us a long time to put together, but it's really working really, really well in the current market in the face of all of the issues that a lot of the property market is encountering. So that's it from me.